Hey, this is Chris from StockSpot. Now, every few months in Australia and the rest of the world, earnings season rolls around. Markets jump around, stocks go up and down. There's headlines all over the place about whether companies had good results or bad results, and there's a lot of interest in what those results are. But if you're actually that infatuated by what these company results are, you're probably, in my view, taking too much risk in your portfolio. And that's because these days, most information that comes out in those earnings press releases, the market already knows. And if it doesn't already know by the time that earnings release comes out, it's factored it in very quickly. So trading around these decisions, or actually adjusting your portfolio after earnings decisions, is really like chasing a train after it's already left the station. There's not much point if you're not already positioned in the correct way before these announcements, which is why, in our view, you don't need to be worried about them all, particularly if you're well diversified and only have a relatively small allocation to every individual company within your portfolio.
Sorry for interrupting, but I'd like to take a moment to talk about my channel. Now, most people who watch my videos don't subscribe to my channel, which means that they don't find out about other videos I'm making, and it doesn't share the love with others who are interested in investing. So if you are interested in videos like this, I would encourage you to please subscribe to my channel so you find out more about the videos we're making here.
Now, this didn't always happen to be the case. In fact, there was some research on earnings announcements back in the 1980s, and what that research discovered was that after a company announces good news, typically the share price continues to move upwards for a period of time, and vice versa if there's bad news. This was known as post-earnings announcement drift, and it was tradable. You could actually buy stocks that were announcing good results and make money, and sell ones that weren't, and they'd fall. But actually, as markets become more sophisticated and more fund managers have entered the market and more eyes are on every earnings result that comes out, that opportunity has been arbitraged away. So these days, there isn't really much of an opportunity at all in trying to get in and out of stocks based on the earnings results. Those announcements gets embedded in the share prices almost immediately, and so you're too late if you're reading it in the news headlines the day after. So earnings season always creates a lot of news and a lot of headlines on how stocks are performing, but if you're a long-term investor and well diversified across the whole market, my tip would be completely ignore it. There's really nothing in there that's going to change your investment strategy, and it shouldn't change your investment strategy. Let everyone else worry about whether earnings results are good or bad, and let your strategy do the work for you.